Something is deeply wrong in the silver market right now, and the numbers prove it. Today, we are looking at a situation that should not exist if basic supply and demand logic were functioning normally. China has just reported that silver production in February increased 0.81% month over month and 8.17% year over year. Output is rising. Smelters maintain normal operations even through the Chinese New Year holiday. More silver was produced than last month. More silver was produced than last year. And yet, at the exact same time, Shanghai warehouse inventories have fallen to their lowest levels in more than a decade. Think about that carefully. Production up more than 8% year over year. Inventories sitting at 10-year lows. That is not a small divergence. That is a structural contradiction. The math does not reconcile. When output expands and stockpiles collapse simultaneously, something fundamental is happening beneath the surface of this market. And the price action is already responding. Silver just surged 6.21% in a single session to close at 94.39 per ounce. The market is not hesitating. It is reacting to scarcity in real time. Before we go further, let me outline exactly what we are going to establish. First, we will break down the Chinese production data and explain why that 8% year-over-year increase actually strengthens the bullish case instead of weakening it. Second, we will examine the backwardation structure now appearing in the silver market and why it is one of the clearest signals of physical tightness. Third, we will connect industrial demand, especially from solar manufacturing, with the inability of inventories to rebuild even while smelters run at full capacity. And finally, we will assess what all of this implies for silver prices in the weeks and months ahead. This is not speculation. These are production reports, exchange inventory numbers, and observable price structures. When rising output meets collapsing inventories, that is not contradiction. It is confirmation that demand is overwhelming supply. Now let us examine the production data itself. China's silver output in February increased 0.81% compared with the prior month and 8.17% compared with the same period last year. Those headline figures suggest strengthening supply. At first glance, you might assume that higher production should relieve pressure and stabilize inventories. But the context behind those numbers tells a very different story. Smelters reported maintaining normal production levels during the Chinese New Year holiday. That is unusual. Historically, operations slow during that period. Workers take leave, and output declines temporarily. This year was different. Smelters kept running because market conditions were strong, supply of silver ingots was tight, and premiums had risen significantly. They were not operating aggressively because supply was abundant. They were operating aggressively because demand was intense, and premiums justified continuous production. Some facilities reported that elevated spot premiums were high enough to cover the costs of remelting non-compliant inventory. In plain terms, that means older material that did not meet specifications was being melted down and refined to meet demand. That is not behavior consistent with surplus conditions. That is behavior driven by scarcity pricing. When immediate delivery commands a premium large enough to justify extra processing costs, it indicates that buyers are willing to pay for availability now, rather than wait. Another contributing factor was the arrival of imported crude silver and large raw ingots in bulk during February. Several smelters increased toll processing volumes because foreign crude material flowed into China for refinement. Why would that occur? Because refining margins were attractive due to strong demand for finished product. The economics favored importing raw input and processing it domestically. That is a signal of high downstream pull, not slack supply. Additionally, a lead smelter in Shanghai that had undergone maintenance earlier resumed production, restoring additional capacity. On paper, this looks like expanding supply capability, but even with these positive drivers, constraints remained. Some smelters maintained steady production rather than aggressively increasing volume targets. February had fewer calendar days than January. Routine maintenance at certain lead smelters in Hunan and Yunnan reduced the availability of refining feedstock. Output at those facilities was projected to remain below normal in both February and March. In other words, production rose despite operational friction. Now here is where the contradiction becomes undeniable. If output climbed more than 8% year over year, if smelters operated through the holiday instead of slowing down, if non-compliant material was remelted, and if imported crude silver flowed in for processing, then inventories should have expanded. Yet warehouse stocks monitored by the Shanghai Futures Exchange and the Shanghai Gold Exchange fell to their lowest levels in over a decade. That is the critical data point. Increased supply did not rebuild stockpiles. It was absorbed immediately. This is where demand enters the equation. Industrial and investment demand are consuming every ounce that reaches the market. China's solar industry alone continues to require massive quantities of silver for photovoltaic panel production. Silver remains the most electrically conductive metal available, and there is no scalable substitute in this application. China dominates global solar manufacturing. As installations expand, silver consumption rises in parallel. This is structural demand, not speculative demand. The inventory figures confirm this drawdown. The decline is not marginal or seasonal. It reflects sustained depletion of above-ground stocks, and the market structure is confirming the same message. The silver market has entered backwardation. Under normal conditions, futures prices trade at a premium to spot because storage and financing costs are embedded into forward delivery. That is called contango. Backwardation is the opposite. Spot prices exceed futures prices. Silver available today commands a higher price than silver promised for future delivery. This occurs when immediate physical supply is scarce relative to demand. Right now, spot premiums exceed futures pricing. That means buyers value immediate delivery more than future contracts. The market is signaling urgency. Participants are willing to pay more for metal in hand than for paper promises months out. Backwardation is one of the strongest indicators of tight physical conditions. When you combine these elements, the picture becomes clear. Production increased 8.17% year over year. Smelters operated continuously through the holiday. Non-compliant inventory was remelted to meet demand. Imported crude silver was processed. Yet inventories reached decade lows, and the market structure shifted into backwardation. This is not a temporary fluctuation, it reflects structural imbalance. Silver's 6.21% single-session surge to $94.39 per ounce was not random volatility. It was repricing based on physical realities. Even after a 19% correction over the prior 30 days and a pullback from the 52-week high near $117, the underlying deficit remains intact. The price movement reflects that tension. Now consider the behavior around the holiday period. Downstream processing enterprises typically halt operations during the Chinese New Year. That pause should allow inventories to accumulate while smelters continue producing. In theory, stockpiles should build during that window. But according to survey data, smelter inventory was transferred almost immediately after the holiday ended, often within a single day. Material was either moved into social inventory or shipped directly via long-term contracts and spot orders. Compared with prior years, the post-holiday demand surge was stronger and overall inventory buildup was minimal. Even under conditions favorable to accumulation, stocks barely rose before declining again. That is the defining feature of structural deficit. Production increases are insufficient to outpace consumption. Each incremental ounce produced is matched by incremental demand. The system cannot meaningfully rebuild reserves. The backwardation structure reinforces that message. Spot premiums above futures pricing indicate buyers are competing for immediate supply. This is the financial crux. Rising production does not equal easing supply if demand growth outstrips it. When inventories collapse despite expanded output, the conclusion is not surplus. It is scarcity. The silver market today is reflecting exactly that dynamic. And in the next part, we will examine how traders, long-term holders, and short-term volatility intersect with these structural signals and what it means for price trajectory going forward. Now that we have established the production and inventory contradiction, we need to talk about how different participants in this market are positioned, because understanding who is holding what and why matters just as much as the raw numbers. There are two dominant groups operating in silver right now, and they are reacting to the same data in very different ways. On one side, you have long-term physical accumulators. These are individuals and institutions who buy silver, take delivery, and hold it with a multi-year time horizon. They are not focused on daily volatility. They care about structural supply deficits, industrial demand trends, and inventory drawdowns. For them, the fact that production increased 8.17% year over year while inventories fell to decade lows is not alarming. It is validating. It confirms the thesis they have been building around for years, that supply growth is constrained while demand continues to expand. On the other side, you have traders and short-term investors. These participants operate on price action, momentum, and technical signals. Over the past 30 days, silver declined approximately 19%. That is a sharp correction. The metal pulled back significantly from its 52-week high near 117 reached earlier. For traders who entered near the top, that correction created pain. When markets move down rapidly, sentiment shifts quickly. Confidence weakens. People begin to question whether the previous rally was justified. So when silver suddenly surged 6.21% in a single session to close at $94.39, traders had to decide whether that move represented the beginning of a new upward leg or simply a temporary bounce within a broader pullback. Here is where the underlying physical data becomes critical. Short-term price fluctuations can occur for many reasons that have nothing to do with long-term fundamentals. Profit-taking, liquidation of leveraged positions, algorithmic trading responses, and shifts in macro sentiment can all drive temporary declines. But physical inventory levels and production constraints do not change overnight. The fact that Shanghai warehouse stocks are sitting at their lowest levels in more than a decade does not disappear because price corrected for several weeks. The fact that smelters ran through the Chinese New Year holiday due to tight supply and strong premiums does not reverse because futures traders reduced exposure. This is why it is important to understand which category you belong to. If you are accumulating silver with a multi-year horizon, then a 19% correction does not invalidate the structural deficit thesis. The data still shows production struggling to keep up with demand. Solar manufacturing continues consuming large quantities of silver. Electronics production continues. Industrial consumption remains strong. If anything, lower prices during corrections can provide accumulation opportunities for those who believe in the long-term imbalance. For traders, however, volatility is both opportunity and risk. A market that can decline nearly 20% in a month and then rally more than 6% in a single session is a market that demands discipline. Backwardation adds another layer of complexity. When spot prices trade above futures prices, it indicates immediate scarcity. That structure can lead to sharp upside moves if short sellers are forced to cover positions quickly. Snapback rallies can be aggressive and rapid, especially when physical tightness underlies the market. But that same volatility can work in both directions. Without a clear strategy, traders can be caught on the wrong side of sudden reversals. Now let us examine the inventory dynamics more closely because they provide insight into why volatility may remain elevated. During the Chinese New Year holiday, downstream enterprises typically halt operations. That creates a temporary demand pause. Meanwhile, smelters in February maintained normal production levels. In theory, that combination should have led to noticeable inventory accumulation. Production continues while consumption pauses, so stockpiles should increase. Yet according to survey data, smelter inventory was almost entirely transferred within 1 day after the holiday ended. The metal did not linger. It was moved into social inventory or shipped out immediately through long-term contracts and spot transactions. Compared with previous years, downstream demand after the holiday was relatively strong. Inventory buildup was smaller than normal. Domestic social. Now we need to step back and evaluate what all of this means going forward, because data without interpretation does not help anyone make decisions. We know production in February increased 0.81% month over month and 8.17% year over year. We know smelters maintained normal operations through the Chinese New Year holiday due to tight supply conditions and elevated premiums. We know some facilities remelted non-compliant inventory because spot premiums justified the additional processing cost. We know imported crude silver flowed into China for toll processing because refining economics were favorable. We know additional capacity returned online after maintenance. And yet, despite all of that, Shanghai warehouse inventories fell to their lowest levels in more than a decade. That is the foundation. The next layer is market structure. Silver moved into backwardation, meaning spot prices traded above futures prices. That structure does not occur in balanced markets. It occurs when immediate physical supply is scarce relative to current demand. Buyers value metal in hand more than promises of delivery months in the future. That is not sentiment. That is pricing behavior. When the spot market commands a premium, it reveals urgency. Now consider price performance in context. Silver surged 6.21% in a single session to close at $94.39 per ounce. That was not a minor fluctuation. It was a significant repricing event. At the same time, over the previous 30 days, silver declined approximately 19%. Earlier, the metal reached a 52-week high near $117. So what we are observing is not a smooth trend. It is volatility within a broader structural setup. Since the start of 2026, silver has posted a gain of more than 30%. Even after the correction, year-to-date performance remains strongly positive. That tells you something important. Corrections can occur within larger bullish environments without invalidating the primary trend. The critical question is whether production growth can catch up with demand growth. According to projections, China's silver output in March is expected to increase about 8% month over month. Medium and large-scale smelters in Henan, Hunan, and Shandong have slightly raised production plans. Lead smelters that reduced output due to maintenance are gradually resuming operations. Precious metal output is expected to return to normal levels by late March. That is the supply outlook. But returning to normal does not mean exceeding structural demand. It simply means capacity utilization stabilizes. On the demand side, downstream industrial demand after the holiday was stronger compared with previous years. Solar manufacturing continues absorbing substantial quantities of silver. Electronics production remains ongoing. Investment demand has not disappeared. These are not temporary factors tied to a single event. They are structural drivers embedded in broader economic and energy transitions. Solar installations require silver for photovoltaic cells. The metal's conductivity properties make substitution difficult at scale. As long as renewable energy expansion continues, silver consumption remains supported. So the tension remains unresolved. If supply growth merely returns to normal levels while demand continues expanding, inventories cannot rebuild meaningfully. The February data already demonstrated that even when production runs through holidays and imports supplement refining, stockpiles still decline. That suggests the system is operating near its limits. Each incremental ounce produced is quickly absorbed. Now let us address the bearish considerations honestly, because no market moves in a straight line. A 19% decline over 30 days is not trivial. That type of correction can damage confidence and reduce speculative enthusiasm. Single-day rallies, even strong ones, do not automatically confirm a new uptrend. It is possible that volatility persists. It is possible that macroeconomic conditions influence industrial demand. If global economic growth slows significantly, some industrial consumption could soften. These risks are real. Anyone ignoring them is not conducting balanced analysis. However, the February production report and inventory data do not reflect surplus conditions. They reflect tightness. The backwardation structure confirms that tightness. The inability of inventories to accumulate during a seasonal demand pause confirms that tightness. The fact that smelters maintained operations through a period when they historically slow down confirms that tightness. And the fact that premiums were high enough to justify remelting non-compliant inventory confirms that tightness. These are not speculative interpretations. They are observable behaviors driven by pricing signals. This brings us to price implications. When markets operate under structural deficit conditions, price tends to find support during corrections. That does not eliminate volatility, but it limits sustained downside unless demand collapses. If inventories stabilize or begin to rebuild, that would signal that supply is catching up. Backwardation would likely normalize. Price pressure could ease. But if inventories continue declining or backwardation deepens, the market will interpret that as persistent scarcity. Under those conditions, upward repricing becomes more likely. Right now, the evidence leans toward continued tightness. Production increased, yet inventories fell. Holiday conditions that should have allowed stockpiles to rise did not produce meaningful accumulation. Demand absorbed available metal rapidly once operations resumed. Spot prices traded above futures, and silver demonstrated its ability to surge more than 6% in a single session when scarcity signals intensified. It is important to separate emotion from analysis. During corrections, fear amplifies. Participants question their thesis. During rallies, optimism expands rapidly. Neither reaction changes production figures or warehouse data. The numbers remain constant regardless of daily price fluctuations. That is why disciplined strategy matters. Long-term accumulators focus on structural supply and demand. Traders focus on risk management and defined entry and exit points. Both approaches can work, but only if they are aligned with time horizon and tolerance for volatility. Let us summarize the key conclusions clearly. First, China's silver production rose 8.17% year over year in February, yet inventories dropped to decade lows. That is confirmation that demand is absorbing increased supply. Second, the silver market entered backwardation, with spot prices exceeding futures prices. That is a textbook indicator of immediate physical scarcity. Third, despite a 19% correction over the prior month, silver remains more than 30% higher since the beginning of 2026 and recently surged 6.21% to 94.39, reflecting rapid repricing in response to tight conditions. Fourth, production in March is projected to rise around 8% month over month, but that represents normalization rather than structural surplus. Demand drivers, particularly in solar manufacturing and industrial applications, remain active. The unresolved variable is whether supply growth can outpace demand growth. If it cannot, inventories will remain under pressure. Backwardation may persist. Price volatility may skew upward over time. If supply eventually exceeds demand, inventories would rebuild and price pressure could moderate. But based on current data, the system does not appear to have reached balance. This is the reality of the silver market today. Production is rising, but not fast enough to restore stockpiles. Inventories are low by historical standards. Market structure signals scarcity. Price volatility reflects that tension. There are risks, and corrections can continue, but the fundamental signals are aligned toward tightness rather than surplus. Investors and traders must evaluate this information within the context of their own strategies. Volatility is inherent in commodity markets. Prices can move sharply in both directions, but understanding the difference between paper fluctuations and physical supply constraints provides clarity. When production increases fail to rebuild inventories, it suggests the market remains structurally constrained. And when spot prices command premiums over futures, it indicates buyers value immediate access. The financial crux is straightforward. Rising production combined with falling inventories is not contradiction. It is confirmation that demand is overwhelming supply. Backwardation reinforces that conclusion. Recent price action reflects that tension. The data is clear, the signals are consistent, and as long as those signals persist, silver remains a market defined by tightness rather than abundance.